Gold has seen little follow-through to the downside, but it continues to struggle with that 1,300 level to the upside. For a look at gold and the recent price activity, I want to bring in David Fischer, the founder and CEO of Landmark Capital. David, welcome to Futures with Ben Litchtenstein. Thanks for coming on this morning. Has gold lost some of its luster with higher rates, and have they forced the investor to look elsewhere for flight to quality safe haven products like treasuries and the dollar?
Yeah, there's certainly been, you're right. There has not been a movement towards gold because of the two primary emotions, fear or greed. You know, Alan Greenspan said this: the number one dictator of market influence is human behavior, and that being emotions. And certainly the fear factor is not here. There's not enough information out there that's causing a financial crisis. Certainly, there's not enough greed in the market to cause people to drive towards gold. Last year, we went up 13%. This year, we're flat for the year, slightly down. But it's been stuck in a trading range of 1310 to 1356 for quite some time until it broke to the downside, which I talked about on your program last time on April 24th, that we would probably see gold break down. It didn't break through the support level of 1275, but it was hovering around the 1282 level. So there's not a whole lot of demand, the hurrah for gold. I know this is not what gold bugs out there want to hear from me, but I have to call the market how I see it is. Oh, yeah. There are some big money coming into the market, though. I will say recently the Canadian asset managers are looking at purchasing gold. The news just came out yesterday. They see it as an undervalued asset. There's a big show and investment conference a month and a half ago where Jeffrey Gundlach, who's one of the largest bond traders, predicted a huge movement towards gold. He's saying that it's undervalued, and he's looking at it from a technical side, saying that it's developing a head and shoulders. And he predicted, he didn't say when this was going to happen, but he could say that you could see gold up $1,000 significantly. I don't know if I hold that opinion, but he's got a lot more market experience than I do. Yeah. But, you know, the brilliant thing about it is that at this conference, where there's 25 major investors who are multi-billionaires, most of them are bears in the gold market. There's been a lot of bulls turning towards this market, but the sentiment hasn't come out and actually put in the amount of trades in the market to influence the spot price of gold. Yeah, gold kind of reminds me of that Steelers Wheel song from back in the day. It's got geopolitics to the left, dollar to the right, and it's kind of stuck in the middle here right now around that 1300 level. But David, you've been on enough to know that we like to talk about correlations here on Futures with Ben Litchtenstein. And one of the big ones is the gold-dollar correlation. You touched on that. A little bit of a breakdown over the last couple months there. I'm curious, why is the dollar-gold inverse correlation not been as reliable over the last few weeks as it has, well, traditionally is? Well, you know, you bring out a great point, Ben, because if you look at the dollar correlation to gold, gold should trade about $125 to $150 lower than where it is currently, compared to the dollar correlation being at 94 and touched briefly a point at 95. When it was at the low 1300s and I was on your program and I said it was going to go to 93, the dollar index was around 90.77 on that day, and gold was 1305, 1308. So if the correlation historically is in place, we should see much lower prices in gold by at least $100. This should tell us something. Gold is either undervalued or gold is much more stronger than investors think it is in the headwinds of the dollar moving to the point of where it's at. Now, I'm going to make another prediction. I think we're in and you know more about this than I do for trading currencies, but I think we're on the upper side of the dollar range of the index there. And I think we're going to see some flatlining in the dollar, maybe even third quarter, fourth quarter, lower dollar values, maybe slightly higher gold prices. But right now, the correlation is not intact as a one-to-one movement, inverse relationship between dollar and gold. I think it's going to come back because we have some financial problems that we're going to face next year. with the amount of treasuries that the Treasury market has been creating. It's unreal. And those are going to correlate to either higher dollar prices or possibly this time we might see a run towards safety in gold.
You know, David, that'll be interesting to watch. I'm curious if you think that's because the Fed now, well, if they do raise again this year, they will have reached that 3 raise target that they had. And do you think that's going to kind of just dampen some of the demand for the dollar?
Well, I think not many people are talking about this, but let's look back. The Treasury announced that in 2016, they produced $560 billion of treasuries to support the overspending of the government. Let's put it in this perspective now. This year in January, they said they need $955 billion. So there's a big increase there. But that wasn't the right number. And February 2nd, they revised that and came out and said we need 1.16 trillion. And 2 weeks later, they came out with their annual report saying, no, we're going to need a lot more. And if you look at the fourth quarter or the first quarter, we produced in the first quarter of treasuries $488 billion. If you amortize that over the year and average it out, it's a staggering number, $1.95 trillion. So from 2 years ago, 560 to 1.95, this tells us we have a environment where we have a spending problem. The debt's been escalating 34% faster than the economy, and all this is going to come home to roost as rates get higher next year, and the Fed is at full capacity unraveling their balance sheet at $600 billion a year, and they're going to do that for a couple of years. So I think by 2019, the end of that year, or early 2020, the landscape of the gold versus the dollar and the Treasury and the debt, that's going to be totally different than what we're facing today. So if you're a contrarian and you're a long-term hold, buying gold at these levels, I don't think you're going to get hurt much. This is the time for accumulation. But those that don't want to have patience and wait, there's other investments. But you're not going to see big spikes in the gold or, in fact, any of the markets, quite frankly, in metals right now.
Yeah, that should be interesting to watch. And there's a lot of people that are talking about that supply in terms of the treasuries and how that actually could potentially drive yields higher. But again, we know that with the Fed on the move here, that we expect to see yields continue to hold at these upper levels here. But let's keep a close eye on that. Real quick, I want to get your thoughts on silver because we've been watching it parked here at the 1650 level. Why is the market in such a narrow range? And is there anything on the horizon with potential to cause a breakout?
It's stuck in a dollar range from 1560 to 1660 in essence, give or take 10 cents. I don't see any major things. Silver's in the shadow of gold. I think we need to have a gold market movement to have a silver market. I don't adhere to the idea of, $35 price point range of silver this year that I hear a lot of my competitors talk about. I just don't see the technicals, and I certainly don't see the fundamentals for silver. But I will say that silver will move on the coattails of gold, but I don't see that happening in the near future.
All right, David, I appreciate you coming on this morning, sharing some thoughts on the metals, and we even got into the treasuries a little bit there as well. Traders, that's David Fischer, the founder and CEO of Landmark Capital.